Coming up today, the stock market continues its pullback, Jay Powell turning hawkish, the latest political moves affecting markets, Disney surges higher, the Feds go after poly market, and all the latest moves from billionaire hedge fund investors. You don't want to miss this one, guys. Let's go. And welcome back, everybody. Looks like we're continuing this pullback here today, pretty much right across the board. Every sector except energy, now downtrending, and we can see that in the sector performance table today. Every sector finishing lower, led down by small caps. Bit of a pullback and what's been working really well of late, with many growth names down across the board as we get a little pickup in volatility here. As I've been thinking for a few months, we may start getting a hawkish Jay Powell after the election, which looks to be playing out. And stick with me today because later on I'll share with you some of the latest moves from billionaires and hedge fund investors as we just got their Form 13Fs for Q3, showing their portfolios and what stocks they've been buying and selling, which I'm sure you'll find interesting. And I'll also share a stock with you that could benefit from the recent announcement of Robert Kennedy Jr. to head up the US Health Department and what his views are on certain things and some stocks that are getting sold off really hard in response to that as well. We've got quite a lot going on out there, so hang around today. I've got a jam-packed one for you. But first, let's just start off with what spooked markets a little bit here today. Jay Powell, Federal Reserve Chair, in an interview today said the Fed doesn't need to be in a hurry, cut interest rates. What we're currently witnessing is a bit of a flip-flop. It's gone from ultra dovish right in front of the election, doing a historic dovish cut, 50 basis points, when nothing was falling off a cliff, to now saying, we don't need to be in such a hurry. And as my regular viewers know, this is something I've been talking about for the last couple of months. It is kind of crazy to watch it actually playing out, of him changing his tune, which begs the question, why exactly did he get so dovish right in front of the election? And now all of a sudden afterwards, he's coming out with a hawkish tune. Are we supposed to just believe both of them were a coincidence? And this was on the back of PPI inflation, which did come in as expected. Inflation just kind of hanging around here in the mid-high twos, with core a bit higher in the low threes. Nothing really changed since he cut 50 basis points on the 18th of September. And the jobs market's still holding up as well. In fact, jobless claims fell to a 6-month low. So it's kind of looking like he didn't need to cut 50 basis points, like we said back on that day. But it is good to know that the Fed put is still there. He did say, in the case of a financial stability event, the Fed can use emergency tools, aka the Fed put. And it seems like Jay's just getting pushed around by the market and politicians. Going into their September meeting, the market was screaming at them, along with Elizabeth Warren, to do a big cut, which he bowed over deeply and did. Ever since then, the yields have shot up, and that has been truly extraordinary, unlike anything we've ever seen in the past, ever since the Fed cut rates, as the bond market has also done a flip-flop. But don't get me wrong, I still think the risks are to the upside. In my opinion, at this point of time, we're more likely to see a resurgence in inflation than a recession. Over a quarter of all US dollars in existence were created in the last 4 years. Record government spending and Federal Reserve money printing. That ocean of currency and liquidity isn't just going to wash out of the system overnight, nor could even the best policies in the world correct that straight away. And now we've got animal spirits going again. We certainly could get an uptick in inflation, and it may indeed be the right move for the Fed to go on hold. Just looking at Goldman Sachs, macro note out today, they expect the second Trump administration to bring higher China and auto tariffs, much lower immigration, some fresh tax cuts, and regulatory easing. If so, the US economy should grow 2.5% in 2025, outperforming consensus expectations and other developed market economies for the third year in a row. The biggest risk is a large across-the-board tariff, which would likely hit growth hard. And that's the big thing that needs to play out, and why I think we could see some volatility in Q1 and potentially going into it if we get some pronouncements of what we're likely to see. That, of course, would be against bullish seasonality. But just like his last term in office, we can expect to see bouts of volatility, episodes, surprises, and we shouldn't expect everything to stay smooth the whole time. That's pretty much our job as stock investors and traders. We're selling volatility risk insurance, and that's what we earn a premium for. But interest rate traders are increasing their odds that the Fed will stay on hold next month, now approaching 50-50. And just looking at the price action in the 2-year government bond yield today, it held firm as well, 4.35, really narrowing the gap between where the Fed was and where the market was just the start of last month. Almost catching up at 4.75, 40 basis points in difference now. So just as the market's thinking, the Fed may indeed only have 1 or 2 more cuts left in them before hitting the brakes, which, like I've been saying, if GDP and corporate EPS continue to hold up, it should be fine for the market. Of course, we'll see bouts of volatility and pullbacks though. Probably likely to do around tariffs, and especially if we see China bite back in a big way as well. But the market did react very favorably and strongly the day after the election. Looking back in history, that typically bodes well for forward returns. In the dark blue, when we get a positive post-election day performance, on average 6 months out, we're up 8.5%, a little bit better 12 months out as well. And we're getting new announcements every day from the incoming administration that is having ripple effects across all financial markets. The incoming president wants to scrap the electric vehicle tax credit. That's a $7,500 tax credit, part of Biden's Inflation Reduction Act, enacted in 2022, and what the Tesla bears argue is responsible for Tesla and Elon's success. However, Elon came out recently and said he's in favor of it. Tesla doesn't actually need it, and he's actually worried about his competition. This will hurt the General Motors and Fords a lot more. Just like Tesla analyst Dan Ives says, Trump is bearish for the EV industry but bullish for Tesla, and he reiterated that again today when he said, in line with our thoughts over the past week, Tesla has the scale scope that is unmatched. Losing the EV tax credit will enable Tesla to further fend off competition from Detroit, as pricing scale scope is unmatched when compared to the rest of the auto industry, which I agree with as well. Pretty much every other automaker in the world can't sell EVs at a profit, nor anywhere close, nor at the operating margins that Tesla does. They're head and shoulders above the industry. In my opinion, it's already been won, not only with their technology, brand strength, but also their margins, thanks to Elon's ability to drive efficiency. But no doubt that spooked the market a little bit, especially coming from this really technically overbought area. We got so stretched there a few days ago. 38% above the 50-day VWAP, so no surprising to see a bit of a pullback here. However, I don't think that'll have that huge an effect on Tesla. Plus, the long-term strategy shouldn't be to rely on regulatory credits to succeed, so they'll have to adopt without them anyway. One of the biggest effects going to be from this new admin could be a drastic decrease in government spending, which may actually cause a bit of volatility and pain as we transition into a totally new government. Looking over the last 10 years, tax revenues increased 60%, while US government spending has increased 93%. Simply unsustainable, and what the new incoming admin is looking to correct. Of course, easier said than done, if even possible, within just a couple of short years. But we're getting a big radical change coming for the US government. It's going to be run like it's never been run before, potentially set an example for the rest of the world. I'd certainly like to see some of these new measures adopted in my home country. Like all the actions of the Department of Government Efficiency will be posted online for maximum transparency. They're going to take feedback from the public, and they're also going to have a leaderboard for the most insanely dumb spending of your tax dollars. This will be both extremely tragic and extremely entertaining. For example, stuff like a congressional liquor store. Apparently, Pelosi opened a liquor store in the House where members can buy alcohol with their taxpayer-funded MRAs. I'm sure this is just one of many ridiculous ways US taxpayer money is being spent that's likely to be eradicated. And stick with me because I'll show you examples how we're already getting a bit of a pushback with the feds going after Polymarket. But the point is, this does affect us traders and investors. New admin just named Robert Kennedy Jr. to head up the Department of Health and Human Services, and he's been a very big, outspoken critic of the way the system currently operates. The quality of food in America, the alarming increase in the amount of kids with disease, and the declining life expectancy in the world's most richest country. And I gotta say, it is mind-blowing, some of the stuff I hear from Americans and what they pay in healthcare insurance, or just a simple overnight stay in a hospital, doctor's visit. In my opinion, extreme capitalism has completely overrun the US healthcare system. And so some things RFK could do is target the huge cost of drugs in America. Even though a lot of them are designed and made there, they're multiples more expensive than other developed nations. And we're seeing pharmaceutical drugs sell off in this news, as they have done ever since the election. And again, it looks like the market saw it coming, just looking at the price action here in Pfizer. Same with Merck, Johnson & Johnson getting sold off. And since RFK is an outspoken critic of vaccines, of course the vaccine stocks getting whacked pretty hard here as well. Moderna been absolutely slammed these last couple of months. But one area RFK spoken positively about, and the stock I said I was going to share with you, psychedelics, and one company I've been looking at, Mind Medicine, MNMD, 615 million market cap. Coming out of New York, they look to treat brain diseases with psychedelics, which there's a growing body of research to support their use case actually. Still an unprofitable stock, so highly speculative and very volatile as well. But just another potential area of the market that may have a political tailwind, while others have now got a bit of a headwind in front of them. Okay, now over to the latest moves from billionaires and hedge fund investors. Since it's 45 days after the end of the last quarter, Q3, they're required by the SEC to file Form 13Fs. For any manager with more than $100 million assets under management are required to disclose their latest trades and latest portfolio holdings, which are made public. Interesting to see David Einhorn loading up on an agricultural stock that's kind of been written off for dead by the market. That's CNH Industrial, global firm that sells agricultural equipment, which is interesting given they're coming out of London, and I would think they may be exposed to some potential global tariffs. However, the stock does appear to be really cheap. My stock fair value's got it at $18.30, well above where it's currently trading at $10.66. And I always like to keep an eye on what some of the best investors in the world are doing, not just in their actual picks, but also in the sectors that they're investing in and divesting from as well to get an idea of how they're reading the macro and where they see the opportunities. Looking at the biggest and the best, Warren Buffett, as we all know, continued to sell down his largest position in Apple. Now owns exactly 300 million shares, valued just below 70 billion, still a bit over a quarter of his portfolio. And his other longtime favorites still up there: American Express, Bank of America, Coca-Cola, and his fifth and sixth largest positions, oil, Chevron, and Oxy, which is currently still trading below his average entries of late. Looking at Bill Ackman's portfolio, significantly increased his stake in Brookfield Corp, making it now his largest position, and they're an $87 billion market cap investment manager. He reduced his holdings in Hilton, and interestingly, added a lot to his position in Nike, which is a bit of a contrarian bet, as Nike's been punished pretty much all year, so it looks like he's hoping for a turnaround there. Looking at Monish Pabrai, protege of Charlie Munger, and just like the late Munger, prefers to run a very concentrated portfolio. He's still got big bets in the coal industry. In fact, he's been adding to his position in a massively contrarian bet, as those stocks are still undervalued, thanks largely to the ESG movement. Big portion of the entire fund management industry is actually barred from investing in stocks like this. Similar to tobacco, weapon makers, gambling stocks, alcohol, and that's why those stocks can often offer a premium because of that. The famous Michael Burry, portrayed in the movie The Big Short, significantly adding to his positions in Chinese shares. Alibaba is biggest, a quarter of his portfolio. Next, JD. And along with Baidu, he's got almost 2/3 of his portfolio in Chinese shares. Similar story to one of the best investors of all time, David Tepper, also adding to his Chinese positions. Slight reduction in Baba, but he added 173% to Pinduoduo, 69% at JD.com, while also reducing his positions in the China large cap ETF, Baidu, Chinese internet shares, and also reducing his positions in American tech platforms as well, Meta being the most. However, when you add it all up, his positions in Chinese shares, almost 40% of his portfolio. That's a significant bet for a typically well-diversified investor. Also good to see the world's largest hedge fund, Bridgewater Associates, taking new positions in Alibaba and Baidu. And just like Tiger Brokers a few days ago, JD.com actually came out with pretty good earnings, pretty good beat there, 14%. Pretty good outlook, speaking favorably of what they're seeing in the economy, the stimulus bouncing back. However, the market's still really nervous on Chinese shares here. I think the threat of tariffs is going to keep the market on edge for a few months. However, that could present a good opportunity, and we may even potentially get a bounce on Alibaba's earnings tomorrow, as I've got a feeling they're going to come through with a pretty good beat, maybe an increase on their buyback program, and they too may be seeing a bounce back in their consumer. However, you never know what the market's going to do, even on a favorable result, kind of real binary event earnings, up or down. And there's Tiger, still pulling back a little bit, in the mid-5s now, after they had a really good earnings a couple of days ago. And just a quick reminder, I've got a new service coming out next Thursday, which I'm excited to unveil more details on Monday. And like I said, this has never been done before, and it's in response to the survey I conducted a few weeks ago. So I'm sure you're going to find this really interesting. And I had someone ask me, is my new service going to be about day trading, or do I have a day trading strategy that they can learn from me? And so as my long-term viewers know, I don't day trade, and I certainly don't promote day trading to anybody. I never have, and I never will. And that's for good reason, because just like the Financial Regulatory Authority has reported, the day trading failure rate for retail traders is 99%. And so I thought of a good way to illustrate why that is the case, as I think a lot of people, especially those new to trading and that are vulnerable, and that some people that may even be desperate, get lured in to the dream of easy riches from day trading and all the online furus that prey on them. And so I'm going to use a roulette table to explain why day trading is practically impossible for retail traders, you and I. But first, to understand why, you got to understand the stock market is not binary. It's not just up or down. When you look out 1 month or further, there's a huge structural drift to the upside, and for good reason as well. A lot of people don't understand the concept of retained earnings. Even if a company makes the same amount of money each year, its book value can increase over time because of retained earnings and the returns from those retained earnings being invested. Not to mention inflation, population growth, productivity increases, technology, companies buying back their shares, so on and so forth. There's so many reasons why stocks move up structurally over the long term. And that's why shorting them is like trying to fight the tide. So just looking at this research here from Bank of America, as time horizons increase, equity losses drop. So the probability of negative returns based on the S&P 500, and I'd say this is pretty much the same numbers for any good stock out there. So if you hold a good stock or the S&P for 1 day, it'll be up about 54% of the time, down 46% of the time. However, if you hold it for a month, your odds greatly improve. About 62% of the time, stocks will be higher a month later. Going out to a year, 74% of the time, the stock market finishes higher each year. Really favorable odds. However, it's not even shown on this graph. However, I can assure you, if you hold a stock or index or anything for a minute, 10 minutes, even 1 or 2 hours, it's probably going to be 50-50, whether it's up or down an hour or two later. That's what day traders are trying to do. They're trying to guess if the price is going to be be higher or lower a minute or hour or two later. But what a lot of traders underestimate, especially new traders, is the huge cost and drag of paying the bid-ask spread. So for example here, the highest bid in the queue may be 54.90, the lowest ask 55. So if you buy at market, you'll pay 55, you sell at market, you'll get 54.90. Now even if you use limit orders, because the algos, they can see order flow in front of you, not to mention their AI algos can read news in a millisecond. When day trading, if you get filled on the bid or ask, pretty much all the time the market's going to move against you a little bit further. Otherwise, a market maker would have got in there, stuck their order in front of you, and made the spread. They pulled their order, left yours in there for a reason. So that's the first cost for day traders. Churning your account all day, paying the bid ask. And so you could think of that like the zero on a roulette table. For those of you who don't know roulette, it's a casino game. The dealer spins the ball, it lands on a number, and depending on where it lands, determines the payoff. For example, you could bet $10 on red, and if the ball lands on a red number, you make $10. Pays out 1 to 1. Same with even and odd, but you can also bet on a single number, which pays out 35 to 1. You can bet on the first 12, the second 12, a square, street, line, whatever you want. However, just to keep it simple, we'll just talk about red and black. Similar to day trading, if you think the stock's going to be up or down a minute or an hour later, it's pretty much 50-50. However, how the casino makes money is from these zeros here, because when the ball lands on a zero, all bets on red and black don't pay off. In other words, the house wins. Because if they didn't have these zeros, they would have no edge, and you could use a simple martingale system to increase your bets, waiting for your color to come up. But that's another reason why casinos have maximum bets, so no one can use a martingale system. However, having these two zeros here gives the house about an edge of 5.8%. And so just relating this to day trading, your odds are 50-50 whether a stock's going to be up or down an hour or two later. And don't think you know a chart pattern that the richest, most well-resourced, high-frequency algo bots out there don't know. With endless money, they can gobble it all up in front of you. So the first zero is your spread, the bid-ask spread, and the two zeros are your commission that you pay to your broker. And that's the house edge to the market. You pay the market maker and you pay the broker, and a small part of your commission goes to the exchange as well. And that's why 99% of retail traders fail, because they just sit there all day churning their account to the benefit of the market makers and the brokers. And so typically anything that seems too easy or anything that feels too good is typically going to lose your money in the long run. And so this is the best way I can think of to illustrate to new traders. I know a lot of you guys out there are already aware of this. Some of you guys have been trading a lot longer than me. I've worked in the pits, run small funds of your own, so I know you guys are well and truly aware of this. However, I'm just trying to help out the newer traders out there who may be lured into thinking that day trading at the retail level is actually feasible or possible. I'm not saying it can't be done, because there are 1% of people out there that can do it, just like there's 1% of people that can beat the casino and blackjack by counting cards. It is possible. It's just highly improbable that as a retail trader, you can do it and have a durable edge that can overcome the house's edge for the long term. Sure, we may have a hot year or two in the market where just about anybody could day trade. However, I'm talking 10, 20 years. A repeatable edge is highly unlikely. And so basically, you'd need a huge structural edge just to break even, overcome the cost of the spread and your broker's commission. And I'd even add some more zeros in there for day trading, the algo's advantage, which on a roulette table, it really is a fair playing field. You see the ball being spun, you see where it lands. However, there's a lot of funny business with algos and day trading. They get to see order flow in front of you. They read news in milliseconds. So that's another disadvantage you have as a retail trader, which, like I said, you'd need to have a huge repeatable edge just to break even and overcome all of that. And I remember all the way back when I worked in an investment bank, even back in 2006, the algos were coming into the markets in a big way back then. I remember the saying back then, by the time you see it, it's already gone. Talking about any possible pattern or edge when it comes to day trading. Like I said, the real edge for retail traders is increasing your time frame. As you guys know, I'm an active investor, also swing trader, average holding time 3-4 weeks, and even that, in my opinion, is cutting it close and a thin margin game. But you holding for less than a day, for most people, it's just practically impossible. And that's why I'll never promote day trading to you guys. Okay, moving on, we just got earnings out from Disney. Looks like they may be turning the ship around after the stock had been beaten down all year. Market's given them a favorable response as they beat estimates for revenue and earnings per share, said they see single-digit EPS growth next year and double-digit growth in 26 and 27. That's pretty good if they can pull that off. Market certainly seems to like it, up 6.2% today. And like I said, it seems to be turning around after getting beaten down pretty hard coming into their last earning. However, they still got stiff competition from Netflix and other streamers, not to mention a lot of consumers that have been pulling back from their theme parks, and they're still going through a bit of a flip-flop on their management and strategy. And just going out to a monthly chart, still well off those 2021 highs. Practically been a lost decade for Disney, like a few of these old blue chips. Really the new economy stocks that have stolen the show over the past decade. And so if China does get slapped with a big tariff, maybe not 60%, maybe 30%, it'll be interesting to see whether that negatively affects them. Exports to US do make up a big part of their economy, why a lot of people work there. However, it's not everything. They may be able to drive domestic consumption, but until China really bounces back, may actually help keep a lid on the price of oil. Not to mention the surplus from around the world, America, OPEC, even non-OPEC countries, pumping it out. We could actually get a major supply glut next year, especially with a really pro-fossil fuel administration coming into the States, which we shouldn't see any regulatory or political bottlenecks, along with the prospect of geopolitical tensions to be dialed down. However, we could still see a showdown with Iran. New incoming administration is a bit of an Iran hawk and has indicated they're willing to continue backing Israel in their war. What happens in Ukraine could be another story though. However, crude seems to be defending this key support zone, around $67 a barrel. But what's really pulled back since the election, gold had been on an absolute roar for months. May got a little ahead of its skis. Seen a big rip up in the dollar since the election, with plenty of people saying market's pricing in a quick bump up in inflation. However, I would expect gold to hold up better in that scenario. I think it could be a case of some geopolitical risk premium coming out of gold, maybe a little bit out of oil as well. However, that doesn't mean the bull market's over. Still in a really strong, medium, even long-term uptrend here that could be shaping up for a bit of a buy the dip swing trade at least. Just looking at Junior Gold Miners ETF, GDXI, and Barrick Gold. My indicators are flashing buy signals here, indicating it could be potentially good swing trade opportunity at these levels. Barrick Gold currently 14% below its 50-day VWAP, bullish seasonality over the coming weeks and months as well. We'll keep an eye on that one. As we are doing in the cannabis sector, new admin wants Matt Gaetz as the new Attorney General. However, the Senate isn't expected to confirm it, as he is a controversial pick, but he is pro-cannabis. It would be a huge win for the industry if he did make it in. That's probably why we traded up really firmly there yesterday. However, on this news today that he might not make it in, maybe causing a bit of a pullback here. However, this could be the process of developing a bottom in the cannabis sector, which we typically see on high volume. But it's not looking good. Just looking at Polymarket, the market's only giving him a 27% chance he will be confirmed as Attorney General. And speaking of Polymarket, surprise, surprise. Just like I've been saying over the past week, we should expect some pushback from the establishment. And it appears one three-letter agency is not too happy with the result of this election. It's made an absolute mockery of the polls, many of whom were saying Harris was set to win. However, us traders following the odds on Polymarket knew the money doesn't lie, and they were actually criticized and accused of manipulation to try and sway the election. However, it was just traders following the data along with their gut instincts of what they could see on the ground. The CEO of Polymarket, Shane Copland's home getting raided yesterday, with agents seizing his phone electronics at his home in New York City, with the company currently under investigation for allegedly allowing US-based users to bet. So they're only supposed to allow offshore users, which they said they have. Of course, some users may have used a VPN to get around it. However, a federal judge just ruled election betting's legal in the States. It's actually another site, Kelshi, which allows it. But would this have happened if the election had gone another way? And is it another coincidence this is happening just 1 week after the election? And just like Shane himself said on Twitter today, it's discouraging that the current admin would seek a last-ditch effort to go after companies they deem to be associated with political opponents. We are deeply committed to being nonpartisan, and today is no different. But the incumbents should do some self-reflecting and recognize that is taking a more pro-business, pro-startup approach, maybe what would have changed their fate this election. Which I've got to say, he's got guts coming out and saying this right in front of their faces as they investigate him, as it's hard to see how this is not politically motivated. However, this has been the case quite a few years now over there, what they call lawfare, and it may actually go both ways as well in the coming years. And speaking of Polymarket, interesting to see the incoming 47th president being priced by the market at 95% chance of being inaugurated. And this is a heavily traded market, over $44 million. Kind of alarming to think the market's given a 5% chance. For whatever reason, he may not make it to inauguration, which would certainly be a tail risk for the markets, not to mention the entire country. Also interesting news in crypto today, Pennsylvania lawmaker introducing bill for a strategic Bitcoin reserve. The legislation would allow the state of Pennsylvania's treasurer to invest up to 10% of its funds in Bitcoin, suggesting a multi-billion-dollar investment, which again would be crazy if the states and at the federal level they start hodling Bitcoin. And if other countries start doing this, well then what's to stop Bitcoin from going to $1 million a coin? There's only finite supply, and if the whole world piles in on it, there shouldn't be anything to stop it going from the moon, unless some of those big Bitcoin whale wallets really start offloading. But with a cult-like following, Bitcoin maximalists who have vowed to never sell, always buy as much as they can, this is one of the most interesting assets of our lifetime. And what happens if it goes to 10 million a coin, 100 million a coin? 99% of the world's wealth being hodled in Bitcoin. What is that going to look like for society? Interesting times indeed. And there's a look at it there today. $88,000 a coin, technically overstretched in the short term, but like I said, there doesn't appear to be anything in its way. So even though we may get a little bit of a short-term pullback here, I'm still expecting $100,000 a coin come Christmas. And if we start seeing more hawkish commentary coming out from Fed members, we may continue seeing a bit of a pullback in the Trump trade as well over the coming days, especially if the market really starts to price in the Fed's going to stay on hold next month. That's all for the daily market review today. Thanks very much for tuning in, and I'll see you guys again this time tomorrow. Cheers.